You're listening to AI PRISM from Seoul Economic Daily.
It's Friday, May 15. I'd like to share some thoughts about Markets Daily.
Imagine trying to hide a screaming sports car engine inside a family minivan. Just to sneak past the highway speed limit.
Right.
That is exactly what South Korean retirement savers are doing right now to force their money into the AI boom. Today, we're looking at a massive structural shift happening in the KOSPI. Capital is just ruthlessly picking winners and losers, and if you're watching global markets, this tech versus legacy divide here is basically a crystal ball.
Yeah, it really shows what happens when money becomes, well, incredibly impatient. We are seeing capital aggressively crowd into AI and robotics, and it's essentially starving out traditional sectors. I mean, just look at the semiconductor surge.
The ETF numbers, right?
Exactly. We recently watched 2 Korean semiconductor ETFs each cross the $2 trillion mark. That's roughly $1.37 billion US dollars.
Wow. And wait, let me make sure I have the mechanics straight here, because one of those is a bond hybrid ETF from KB Asset Management. Why are AI investors buying bonds? That fund hit, what, 2.1294 trillion won, so about $1.46 billion?
Yeah, $1.46 billion. And this is exactly where your minivan analogy comes into play. That specific ETF uses a 50% bond structure to meet the safety requirements of IRPs.
Which are individual retirement pensions, basically Korea's version of a 401k, right?
Right, exactly.
Yeah.
So by wrapping volatile AI memory supply chain stocks inside a safe bond vehicle, retail investors can legally dump their conservative retirement funds straight into the AI race.
Sneaking the sports car past the speed limit.
Precise. And we see the same frenzy entirely outside of retirement accounts, too. Shinhan's SOL ETF just pulled in 1.0505 trillion won, which is about $720 million, driven purely by retail demand for the AI memory supply chain.
Okay, so local money is hacking the system to chase domestic hardware. But what's really fascinating is how foreign capital is targeting Korea's software ecosystem, specifically by using regulatory loopholes. Let's look at Kakao Mobility.
Yeah, there is a very complex three-way deal brewing here. Uber is currently circling to acquire U.S. private equity firm TPG's stake in Kakao Mobility.
And Uber's involvement here matters because of this huge regulatory wall. The Korean exchange effectively bans parent-subsidiary dual listings.
Right.
Since the parent company Kakao is already listed, the mobility arm is stuck. They can't easily go public in Korea.
Exactly. But by taking control, Uber could bypass that domestic roadblock entirely and list Kakao Mobility directly on a U.S. exchange. It really shows how tech companies have the agility to leap over local regulatory walls.
Which is a luxury that traditional legacy companies definitely do not have. While the tech platforms engineer these cross-border escapes, legacy industrials are getting battered by those exact same regulators.
Just trying to survive, really. Look at Hanwha Solutions. They are trying to execute a massive $1.8144 trillion, so about $1.24 billion rights offering.
And just to be clear, for anyone who hasn't been in the weeds on corporate finance recently, a rights offering usually means a company is desperate for cash.
Yeah, it definitely does.
They're printing new discounted shares and diluting their current investors just to keep the lights on. But the Financial Supervisory Service actually stepped in and blocked it. Why are they demanding so many amendments?
Well, the regulator is terrified of liquidity risks right now. They are demanding concrete earnings forecasts from Hanwha, and they forced them to amend their filings 3 times. Because of this severe regulatory friction, the capital raise is now delayed until the 3rd quarter.
Which creates a massive timing risk. I mean, they face their regular June credit review completely empty-handed.
Right.
If they get downgraded before that $1.24 billion arrives, they're looking at an estimated $75 billion, roughly $51 million in extra annual financing costs.
And this exact tension, tech agility versus legacy friction, is perfectly mirrored in the shrinking IPO market. We are down to just 13 listings this year compared to 27 last year.
Right. And in Korea, an IPO isn't just buying a stock. It's a subscription deposit lottery.
Yeah, exactly.
You actually have to park massive amounts of refundable cash just to win a chance at a share allocation. It's the ultimate thermometer for market hype.
And the temperature right now is wildly polarized. Cosmo Robotics pulled in 6.3 trillion won, which is about $4.3 billion in deposits.
Wow.
And on day 1, it achieved Tadabul.
Tadabul. So meaning the stock basically quadrupled its IPO price the second it opened.
Yep, a massive win. But meanwhile, K-Bank, which is a major fintech competitor, heavily stumbled post-listing because the market just didn't buy their valuation.
It really shows the market has zero tolerance for uncertainty right now.
None at all. And as you watch this unfold, really ask yourself, if traditional giants like Hanwha are struggling this hard just to raise survival capital, what happens to the country's broader legacy manufacturing base when AI eventually consumes the entire credit market?
That's today's AI PRISM Markets Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a IPRO award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.